Are you holding two ticking time bombs in your portfolio? In today's video, I'm going to discuss two stocks which a lot of newer traders have gravitated towards, why I think they're so dangerous, and how to avoid blowing up your account if you are doing the wheel strategy. Now, if you don't know who I am, my name's El-Gorr. I'm the founder and CEO of Freeman Publications. I've been trading the wheel for almost 6 years now. I've also written a best-selling book on the subject, which you can get in the links below. And without further ado, let's get into it to look at these two stocks and why I think you shouldn't be trading them. So let's discuss the two most dangerous stocks for the wheel strategy. And before I get into the names of the tickers, I want to preface this because we've had a really good run in the last 18 months, since really the beginning of 2023, end of 2022, but there was a bit of volatility there. So if you began trading the wheel from beginning or mid 2023 onward, these have been really good trading conditions. Certainly a lot easier than trading it in 2022 and in the first half of 2020 as well. And so you have a lot of people who have only been trading for a year or 18 months promoting the idea that you can make these astronomical returns. I've seen people saying 5% a month. I've seen people saying triple-digit returns every year trading the wheel. And most of these people are not bad people. They're not nefarious. They're not trying to scam you. But it is misleading, and it's often based on limited experience and really just being a bull market genius. And because of this, there are two stocks in particular that I see people relying on that really could end up hurting your account and really ruining the whole thing, blowing it all up if you're not careful. And I've seen a lot of these newer traders believing you can get by only trading these two ticker symbols. And that's really concerning. So, what are they? They are TQQQ and TNA. They are both triple leveraged ETFs. TQQQ is 3 times daily returns for the Nasdaq 100, and TNA is 3 times daily returns for the Russell 2000. Now, it's not just that they're 3 times leveraged. That is a big part of it, but that's not the whole story, and I'll go more on that later. And the fact is, the vast majority of people trading these two instruments actually have no idea how both these funds work. Now, the counter to this, straight away, people are going to push back on me saying this. They're going to say, look, Nasdaq in particular, tech's up big. AI is what's driving a lot of the market outperformance over the past 18 months. I'm really bullish on tech. And in the long term, everything will be fine. Even if we get a bit of a dip, the premiums are so large for trading something like TQQQ that I can just get through it on premiums alone. And, in the long term, I'll be fine. So I'll just keep trading TQQQ. And it's really not that simple, because it's one thing to say this, it's another to actually live it. So my counter to the counter is from one of my favorite investors and philosophers of all time, Mike Tyson. Everyone has a plan until they get punched in the mouth. We don't have to go back that far to see times when the Nasdaq did not perform well. This is 2022. So I've actually got here peak to trough. So here we've got, this is November 21, when that post-COVID boom peaked. And then we had a year of absolute misery. So blue line on the chart is regular QQQ, just the Nasdaq 100. And then the reddy purple line, burgundy if you will, is TQQQ. So you can see here, peak to trough, Nasdaq was down 31%. TQQQ, the leveraged version, was down 77% in a year. I can always tell who's never lived through a market crash because they always pray for them. They say, oh, I actually hope the market crashes. I'm going to scoop up a bunch of stocks really cheap. And until you've actually lived through one, you don't realize the emotional stress of going through that. And when we talk about trading, whether it's options, whether it's another trading strategy, it's one thing to talk about sticking to your trading plan during a downturn. It's another thing to actually stick to it. And in my experience, this is not just personal experience, this is from running a company where I've spoken to thousands of people every single day through sending these daily emails. People's risk tolerance is far lower than they think it is. And this is even if they've got the right mindset. For example, in our coaching programs, we've got 400 plus students now. And even just on days where the market dips, I get tons of messages in our community saying, hey, why is this stock down today? Hey, what's up with this one? It's down 8%. What's up with this one? It's down 6%. And once again, that's just coming from a place of fear. No one's ever asked me, hey, why is this one up 8% today? Why is this one up 15%? No one's asking me when it's up. But when it's down, it's all doom and gloom. And once again, this is not just my thoughts. There's actually a lot of studies on this. We've got studies in the CFA Institute and also the Journal of Financial Planning showing that investor risk tolerance falls following market declines. So as conditions get worse and as your results get worse, your risk tolerance actually decreases. So once you actually go into the fire, turns out people don't like getting burned. And we got more data from the CFA showing that underperformance is largely due to market timing and going into a downturn, panicking, selling out, and then not rebuying in until we've got a very clear bull run. And this is even though the biggest moves a lot of the time are either in the midst of a bear market or at the early stages of a bull market, in that recovery stage. That's why the beginning of 2023 profits were so easy to come by, because there were so many big one-day moves, because we were just coming out of the bear market and we were seeing these big leaps in stock on a daily basis. So what actually happens in these downturns? If you see a 50, 60, 70% drawdown in your portfolio, which you would do if you are just trading things like TQQQ or TNA, you aren't going to continue with that strategy. And then switching strategies every 1 to 2 years is a one-way ticket to poor performance, because you're always going to sell out at the very lows, jump to what's ever hot at that time, and then when that doesn't work, you're going to sell out again. And I talk about this a lot. This is really Warren Buffett's big secret to his phenomenal returns. It's not that he was the best performer in any given year. It's that he's never had a year bad enough where he's called it quits. And this predates Berkshire Hathaway. This predates the Buffett Investment Partnership. This is even when he was trading his own money as a 13-year-old. He's never had a year so bad that he's had to call it quits. And that's how you get incredible returns. Not just with options, but with investing in general, is that you avoid these massive drawdowns and keep doing a winning strategy year after year after year. And this brings me to the next point, why I really don't like these two ETFs. It's 3 times daily returns. So you saw in that chart in 2022, the QQQ was down, 31%? But TQQQ was only down 77%. So why is that? Why is it not exactly 3 times higher? It's because it's daily returns they're calculated by. And this is actually worse for you as an investor. So the returns reset at the beginning of every trading day. And let me explain this with an example. So let's say, for example, QQQ starts the day at $100 a share. And the ETF will give you 3 times daily returns on that. So we're going to assume they're the same price just for the ease of doing the math together. So let's say on day 1, the index goes up by 5%. So it closes at 105. With a ETF, if it's 3 times daily returns, it's going to gain 15%. It's going to close the day at 115. Now, nothing amazing or groundbreaking there, but it's what happens if the index falls. So the next day, if the index falls by 5%, the value at the end of the day is $99.75, because now 5% of 105 is slightly higher. The ETF is going to incur a 15% loss, so it's going to fall from 115 to 97.50. So here's the kicker. In 2 days, with a 5% rise on day 1 and a 5% fall on day 2, QQQ only loses 0.25%. The triple leveraged index loses 2.25% because the losses are magnified. So TQQQ underperforms the index by 9 times, not 3 times, 9 times. So in a fairly choppy up and down market, you're going to lose more money with these 3 times leveraged ETFs. And you can see this perfectly here. This is at the very end of the bear market. So very, very choppy market, just how I explained in the previous slide. QQQ was basically flat. It was down 1%. But because of these big one-day moves, the triple leveraged version was down 12% in the same time period. And this is why people aren't going to get the results they think they're going to get unless it's a raging bull market. And the best way to actually highlight this is we just look at TNA's results versus the non-leveraged version of that index. So IWM is the non-leveraged version of the Russell 2000. It's just the standard Russell 2000 index ETF. Annual returns are 9.27% over the last 5 years. In the same period, so the exact same period, exact same stocks, just now we add daily leveraged onto it, the triple leveraged ETF is down in the same period. And that is why you cannot solely rely on TQQQ and TNA if you are trading the wheel. Because while they may offer generous premiums, while you may have had good results in a raging bull market, over the long term, you're going to get more volatility, the drawdowns are going to be worse, and you have a much higher chance of blowing up your entire account. And I don't want that to happen. So here's the solution. First of all, lower your expectations. Anyone who's telling you can make 5% a month, 60% a year, anything more than that, easily, that's what they love to say, oh, it's so easy to do this, is completely misleading you. 20% annual returns, which are a lot more achievable, even when you factor in periods of time when the market isn't so hot, 20% annual returns over a long period, much better than 80% one year, blow your account the next. To do that, you've got to focus on stocks and ETFs, which are less likely to see huge downturns. I'm not a fan of using these triple leveraged instruments at all. But bigger than that, don't get fixated on just trading the same 1 to 2 stocks. You have to be flexible. I always call this being stock agnostic, in the sense that I will trade whatever stocks or instruments are gonna set up to give me the best returns during those trading conditions. For example, in 2022, everything was down. Every single sector was down except for one, which was energy. Energy was actually up 31% in 2022. So what did I do? The majority of my trading that year was done on energy stocks. And yes, you're not going to get the same returns you would trading triple leveraged ETFs. But guess what? The returns will be adequate enough that you'll make it through a year like 2022 without blowing up your account. And then guess who's going to be there when the bull market rolls around again? Guess who's going to be prime? Guess who's going to have a nice big account that hasn't seen a 70% drawdown? That's the key to making the wheel work for you in the long term. So if you enjoyed this video, if you enjoy videos like this, please consider subscribing. Also, I've written a book on this. You can get it down below in the description. And hey, if you do have a decent sized account and you're looking to get more income from said account, we do have a coaching program. So if you want to have a chat about that, there is a link down below to schedule a call with myself or one of the team as well. So I hope you enjoyed this video, and I'll see you in the next one.